Welcome to this explainer. Look, if you're an Italian tax resident with money tucked away in a foreign bank account, you've probably felt that familiar creeping anxiety about tax compliance, right? Well, today we're diving straight into the deep end of Italian tax law for foreign accounts. We're using a fantastic, comprehensive tax report by Francesco Di Tommaso to cut through the noise. Let's turn that anxiety into some absolute, actionable clarity.
So let's just tackle the elephant in the room. The absolute biggest question keeping folks up at night is this. If your money never, physically, enters Italy, do you still owe Italian taxes on it? There's this huge misconception floating around that the revenue agency only cares if your funds actually cross the border into an Italian bank. No way. As we're going to see, the law operates on a totally different wavelength.
Okay, so here's our roadmap for today. We're going to cover 1. Foreign accounts and Italian law. 2. The exact trigger for taxation. 3. When you actually owe nothing. 4. Rates and double taxation. And finally, 5. The mandatory tax monitoring rules.
All right, part 1, foreign accounts and Italian law. Let's lay the groundwork and see exactly what falls under the taxman's radar. According to Article 44 of the TUIR, that's Italy's Consolidated Income Tax Act, the definition of capital income is actually surprisingly broad. If you are a tax resident in Italy, things like interest and other income from mortgages, deposits, and current accounts are explicitly labeled as taxable capital income. Basically, this means interest on your foreign current accounts, foreign deposit accounts, foreign savings books, the whole shebang, it's all strictly taxable. The geographic location of your bank doesn't matter. It doesn't shield you at all, as long as you, the account holder, are an Italian tax resident.
Moving on to Section 2, the trigger for taxation. This is the core of our explainer, and honestly, it's where most people get completely tripped up.
The Italian Court of Cassation recently laid down a massive ruling. They stated that the possession of income coincides with the material availability of interest and with the possibility of freely disposing of it. This right here, this hits the nail on the head. Taxation in Italy for these accounts is all about having the material availability of the funds. It has absolutely zero to do with moving money across borders. The literal second that money is officially available for you to use, bam, the tax obligation is born.
Let's put this into some real-world context with 3 cases from the report. Case A, your foreign bank credits the interest to your account. That's it. The income is received, it needs to be declared, and it's taxable right then and there, even if it just sits there gathering digital dust for years and never sees Italy. Case B, the bank automatically reinvests or capitalizes the interest. Well, even though you didn't withdraw it, you gained economic availability of that return, so yep, still taxable. Now look at case C. Let's say you finally transfer that already credited interest over to an Italian account. Guess what? That's just moving your money around. It doesn't generate a new tax because you already owed it back in case A or B. Make sense?
Section 3, when you owe nothing. Let's lower the blood pressure for a second and look at exactly when you legitimately owe 0 taxes.
Okay, so there are very specific boundaries here. First off, if you've got an account sitting there with 100,000 euros in it, but it generates 0 interest, you have no taxable income. You're taxed on the interest, not the static balance. Simple enough, right? Second, if interest accrues daily but the bank doesn't officially credit it to you until, say, December 31st of the following year, well, that taxable income isn't realized until that exact moment it hits your account. But, and this is a big but, beware of this third scenario. Just because you have a tax-free passbook in France doesn't automatically mean it's exempt in Italy. Unless there's a highly specific treaty applying to your situation, that money remains fully taxable back home.
All right, Section 4, rates and double taxation. So the interest is earned, it's officially available to you. How much of a cut is the Italian state actually going to take?
The magic number here is 26%. The standard substitute tax rate applied to the gross amount of interest you get on those foreign current accounts and deposits is exactly 26%. It's a flat, predictable rate applied right to the gross amount, barring some very specific legal exceptions.
Now you might be wondering, wait a minute, what if the foreign bank already withheld taxes before I even saw the money? Am I going to get taxed twice? Thankfully, no, as long as you follow the rules. If the foreign state already took a slice of the pie, you are still legally required to declare the income in Italy. However, you get to use a foreign tax credit under Article 165 of the TUIR. Basically, this lets you offset the taxes you already paid abroad against whatever you owe in Italy, so it effectively prevents double taxation on the exact same income, which is a huge relief.
Section 5, mandatory tax monitoring rules. We're on the home stretch, but please, pay attention because this is absolutely critical.
Listen,
regardless of whether your foreign interest is taxable or even if it generated literally zero interest all year. If you hold current accounts and deposits abroad, you have to declare them using Form RW. This is to comply with the tax monitoring obligations of Legislative Decree 167/1990. Taxation and monitoring are two completely different beasts. The Italian government just wants to know that these assets exist, period. And trust me, failing to file Form RW can hit you with some seriously steep penalties, totally independent of any unpaid taxes.
So to wrap all this up, let's quickly review the 5 golden rules from the report. 1. Interest on foreign accounts is always capital income under Article 44 TUIR. 2. Your tax trigger is absolutely not about transferring sums to Italy. 3. It becomes taxable the exact second it's credited and available to you. 4. Transferring that money home later doesn't suddenly trigger a new tax. And 5. Expect to pay a standard rate of 26%. And that brings us full circle. But hopefully you're looking at this with a much clearer perspective now, knowing that material availability, not geography, is the true trigger for taxation. Are you fully prepared for the Italian taxman? Have you actually gone back and reviewed your foreign bank statements to pinpoint exactly when your interest was credited? And is your Form RW completely compliant, even for those completely dormant accounts? The rules might be strict, but they are entirely predictable. So take this knowledge, audit your accounts, and stay one step ahead.